Is the Canadian real estate market about to get whacked? That's what I wanted to learn today. So I invited the number one voice that I trust when it comes to the Canadian real estate and treasury market. Her name is Danielle Park of Venable Park Investment Counsel. This is the Jay Martin Show, where we dissect the greatest minds in geopolitics and finance so that we can better understand the world. Here's Danielle Park. Enjoy.
This is Jay Martin.
All right, here I am with Danielle Park. Danielle, it's great to have you back on the show. Thanks for making the time.
Thank you, Jay.
So I want to talk about a handful of things with you. I read your recent client letter a couple weeks ago, and then you fired over some slides in advance of this conversation, which I want to focus on for this talk because I don't know anybody who covers the Canadian bond market and real estate market as well as you do. There's a bit more than that in this deck that you sent me, but I'd like that to be the focus today. And so what we're going to do is kind of different today. We're just going to jump right over to the slide deck. I'd love you to walk me through it, just slide by slide, and take your time diving into whatever you want to as we go through. And I'm just going to fire questions if and when they come up. Does that work for today?
Sure. Sounds good.
All right. So I'll let you share your deck and we'll take it away.
Well, you always ask me you always give me a reason to organize my thoughts in advance of our conversations, and your questions prompted that. So I thought I would organize these. It's always, the discipline, the work of creating content, of writing what you think, of making slides. It forces you to be organized in your brain and your thinking, and to be practical in terms of what does it mean? Like, why are you talking about this? And I find myself, there's the world of talking people about all kinds of opinions on markets and trends and things. And most of it, frankly, trying to predict things which are highly unpredictable. So it's difficult, right? But in my job, I have to actually manage money every day, both for our own family, but also for our clients. So you can't just have theories, you have to actually do things with money. And that is a lot harder than it may sound because in my experience, which is now, more than 25 years of doing this, everyone thinks they're an investor till something goes down. And when something goes down in value, they don't want it. People innately don't want things to go down, right? It starts to chip away at their sense of status quo, a sense of peace and all that. So it's a tricky business because being an investor means you have to take on some risk. But I find that people, generally speaking, especially the ones who have amassed a good amount of wealth, and they're in their 50s or they've saved a lot of their life savings, really are less have a lower risk appetite than many people pretend or think. Mm-hmm. And so that's what makes this all quite tricky. And when I look at the last 2 decades, really, certainly vividly since 2000, I've been following this stuff so closely day after day. And the thing that really stood out in 2000 was this, first of all, the tech bubble of 2000, which drove valuations to obscene levels, unprecedented since the 1929 peak. And then we had, of course, that really brutal bear market that followed. And eventually it wiped out all the exuberance, but it took a while, right? Because people came into it, they'd had an extended bull run where stocks went up so much. Tech stocks went up 100% in 1999, as an example. So when you get that kind of movement, you get a lot of new people pulled in late in the cycle, a lot of people with little experience, a lot of people who start to think that's the norm. Yep. And you get a whole industry that's on fire, right? Whether it's financial media, which was really coming to the fore then, whether it's, everyone offering trading ideas, it really becomes a frenzy. So anyway, that was then in 2000. And then we had that squishing out of all that slowly over time during the bear market when the Fed started cutting interest rates, the tech bubble burst, everything started to go wrong. And by the end of that period, when the market finally bottomed in 2003, Really, people were very off the stock market. A lot of people had just took their chips and gone home and weren't interested at all. But what was fundamentally different back then was that interest rates had started at 5% or 6% at the peak of the cutting cycle, and Alan Greenspan took them to 1%. In June of 2003 and left them there for a year. And at the time, we thought that was so extreme, right? 1% interest rates as a base rate in the banking system was extreme. It had never been seen in many, many decades. And at that point, you started to really get the boom in the housing sector in the US in particular, a lot of credit derivative products, a lot of people, again, going back to, getting money for free. And what are we going to do with it? Interest rates are so low. And then you saw this next big frenzy, which was the housing-led bubble in the United States, which led to commodities, the China story. And then by the peak of that cycle, again, you had this frenzy of appetite for risk-taking, a lot of trading, a lot of misunderstanding about what long-term norms were in financial cycles. And then we got, again, the big ease, the rate cutting cycle as everything was blowing up, and another massive 50% drop in stocks and everything that was sort of risk orientated. And then we got to this place where they went to 0.25 on the base rate, right? 0 to 0.25. And so when we thought it was extreme at the bottom of the 2003 cycle, boy, it got a lot more extreme. So, if you would not be blamed if this has been your experience during this period, which has been really the bulk of my investing experience too. I only had a few years in the late 90s before all this started happening. You would be forgiven if you thought that it was normal for people to cut rates to zero and for everyone to borrow their brains out and spend on credit, because that truly was what's happened or what had happened between sort of 2010 and 2022. But when you look at this chart, which I think is quite instructive, it gives you a little bit of a pullback to the big picture, where you can see there that the average, so now we're talking about real interest rates. We're talking about the rate of interest rates, whether we're talking about a treasury note, in this case, the 10-year treasury, minus the rate of inflation, right? So when you've got a 10-year treasury of 5 and a rate of inflation of 2, you've got real yields are positive to the tune of 3%, right? So over this whole period, the norm or the average was to have positive real yields of about 2%. But you can see there that in 2000, they started to drop below that average. And they really trended down into the bottom of in the peak of the rate cutting, easing, et cetera, in the pandemic. Real rates got the most extreme that they have ever been in my lifetime. And so why that matters is it was essentially paying people to borrow money, right? Like money was so free and inflation was falling during that period that people and governments were handing out money there at the end in that big fiscal easing as well. All those things together made money free, and free money really infected everything. From, that's where we got the rise of the meme stocks. That's where we got the rise of the cryptocurrency mania that we saw. That's where we got the rise of the housing bubble that everyone was, buying 2 and 3 homes by levering off the first because you could, because money was free, because rates were, mortgage rates in Canada, you could get a mortgage at 1.5 there for a while.
Yeah.
So when real rates are that deeply negative, 2 things should stand out. One is that it's extremely unusual. And if you took that chart back farther even than 1960, you'd find that it's almost unprecedented, right? We saw it briefly in the late 20s, which precipitated, of course, all the horror that came after that. But very much behavioral-wise, similar habits were undertaken, which was the speculative frenzy, the throwing money at anything and everything, right? The private equity boom came during that period because all of the normal pensions and savings mechanisms, people opening savings accounts were getting zero. GICs were paying less than 0.5%. Government bonds were less than 0.5%. So all these things that were really the backbone of compound interest growth over time. And especially as people got older, this is where the bulk of savings traditionally have been allocated, with stocks and equities and, credit being kind of the spice, not the main course, right? They were sort of added in traditionally as the longer term part of the portfolio that hopefully over 20 years it would work out. But in the meantime, this is the bread and butter, is this compound interest component. And that really drove the bulk of returns for the last century. But here we had this extreme period where money was worth nothing and everybody started throwing it around. And if you can see in Canada, a similar, you're not seeing that one, are you?
I am. Yep. It transitioned over.
Okay, sorry. So in Canada, similar thing there, where our interest rates have actually been, during this period I was describing, mostly negative since 2000.
Yeah.
So again, for all that time, money felt free. And now, since they started hiking rates in 2022, March of 22, they did this really rapid. And why? Because inflation became a problem really for the first time on a sustained basis in that entire period. Right? Inflation really hadn't been a big deal. It came at the peak of the 2000 cycle briefly. It came at the peak of the 2008 cycle briefly. But as soon as they'd raised rates enough, that filtered through. Demand was contained again. Mm-hmm. People pulled in their spending, and all of a sudden demand rolled over, commodities rolled over, and all of a sudden there was excess supply in the economy, and that really cured the inflation problem. Now you've got the aging demographic that was marching along through this period. I like to point out that the baby boomers are now 24 years older than they were in the 2000 cycle, and every year that they've got older, they've got hopefully some more of their life savings built up, but they've got closer and closer to retirement and or drawing down money in retirement. And indeed, many of them are doing that now. And their risk horizon, their time horizon got shorter and shorter. Their risk appetite ought to have got shorter and smaller. Now, we can touch on this as we go through that, why that hasn't happened for a good deal of the people. But basically then, when they started making real rates positive again. And today, real rates are in Canada, they're about 2.8 or so positive. It depends. Some people use the 10-year yield minus the CPI, and some people use the overnight rate, the Fed funds rate or the BOC overnight rate minus the inflation rate. But whichever one of those you use to test this real rate, it's about 2% today or over 2%. And that's more than the long-term average from 1960. And what it means is that money's not free. And people actually have an incentive now to save, to compound interest. They care whether money's languishing in a bank account or whether they can move that to a high interest savings account or a bond or a GIC where they could get an actual return. And it's really fun for savers that have been out in the wilderness for more than 20 years to see their money actually grow by these compound reinvestments in a sustainable way. And this is just a chart to show that the negative yields were very much behind the Canadian home price bubble, that really took off in 2008 because we came through that crisis much better off than the US. And then we got free money thrown around here. And then you add on the immigration overlay, of course, which has been the last couple of years, an additional, fuel to that whole thing. But it really drove that obsession with housing in Canada. And now, of course, that's rolled over. So that's the first thing. If the other thing I'd like to make clear is that people are very premature in their assessment of how much rate increases have impacted appetite for risk taking and consumption because it moves with such a lag. So it's a couple of years typically from the rate hiking cycle to where you notice the impact starting in the real economy. If you think about the housing market, Jay, we were at peak insanity in Canada. The average home price about $816,000 in the spring of 2022, just as they started the hiking cycle. We still had a lot of appetite. A lot of people took out, as I said, financing when rates were really low. But by the time we got to, June of last year, July of last year, when they stopped the hiking, then we've got that really starting to impact now. A lot of debt coming up for renewal, people having to face much higher interest payments, a lot of motivated sellers coming on the market. We've got the the lowest mortgage origination in the first quarter of 24 that we've seen since 2008. So that's just something to keep in mind. So now we've got the housing market rolling over, which is connected to this real interest rate phenomenon where we're now having to deal with the cost of capital. The same thing has happened, frankly, with the S&P 500. So we all know that the top 5 stocks, the top tech stocks, account for 30% of that supposedly diversified basket, right? And have driven US returns far above global returns in this last 10 years. And certainly in the last 2 years, since October. So, we had a peak in stocks in about the fall of 21, then everything kind of sold off into the fall of 23, really, and then started to rally again. So we've seen this large cap frenzy again, kind of like 2000, leading, especially around AI and chips and this obsession with how much AI is going to change the world. And so the S&P has now once again really out from the last October to about the end of June, far outstripped anything that was any performance. The average stock's actually flat since the late 2021 peak, but the S&P was led by this handful of stocks. And so you saw similar outperformance in large caps, growth names at the peak of the 2000 cycle, which this chart shows, relative to the average stock or the S&P equal weight. The behemoths have really outperformed in 2000 at the peak of 08 and 21 again, and then of late. So what's really interesting about that is it's kind of a similar story. Initially, it's about, they're raising interest rates and, we need to go with the companies that have the deepest balance sheets, the most secure balance sheets, the companies that borrow the bulk of their capital from financial markets rather than the banking system, right? Small and medium cap companies, private, small businesses, they all borrow from the banking system. So they've been hurting a lot as rates have been higher and as stuff comes up for renewal. But the big large cap stuff was still dealing with this cheaper or relatively cheaper money available, certainly through the equity market as prices have rallied in the last 10 months, and also through credit markets, which yields came off significantly in that period as well. So risk appetite, everyone goes, the big caps can do no wrong. AI is the next big thing, and mindlessly just plows money in. Now you've got the passive thing going on today. When we started our company in 2003, we chose to use ETFs, and that was quite a unique decision at that point. ETFs were still just sort of starting to become widely popular. There's a lot of stock picking still going on, coming out of the 2000 bubble. But today, passive flows have become the dominant thing, right? So there's really not a lot of people doing any analysis. It's really just, follow the tail on the donkey in front. And if someone contributes $1 to a 401k or a RSP plan or work plan or whatever, it automatically goes into stocks, which means it automatically goes into these large cap names primarily. So they have a lot of concentration. So what we've seen in the last 5 trading days, Jay, very interesting. That top line is the S&P 500 to the end of June. We had this in our month-end letter for clients at the end of June. That was the S&P 500, just showing what I was talking about. This red band is where stocks peaked at the end of 21, really in this kind of sideways to down market all the way across to sort of right about the fall of, May of 2020, the fall of 23, so that November where you see the big V, then stocks really started to take off again on this idea that, central banks are going to be cutting interest rates. They say that they've probably done enough on the tightening side. And again, this kind of knee-jerk reaction of, if they're going to cut rates, everything's going to be great again.
Right.
Without any appreciation for the fact that, first of all, there's a lag time of many, many months for these changes to filter through. Mm-hmm. And secondly, that the banking system was still extremely tight and we were dealing with real rates, positive real rates for the first time in 20 years in Canada, as an example, and a long time in the United States as well. So for a while, we saw this outperformance again in the same large cap names. The economically sensitive, Russell 2000. This is the in green is the S&P 600 small cap index, and the purple is the equal weighted. Really didn't participate much in this big. It recovered some, but as I say, was primarily back to where it was, in the late 21 cycle. So hadn't made much headway. And then this week, we're starting to see the outperformance in the small caps again. So this has got a lot of excitement because people are looking, this is what happens in this business. Primarily, everyone's long always, right? Most funds, most managers, and especially when you come off a very overvalued period like we've seen in the last little while, people are back, oh, we can't afford to be out of stocks. So if we think that the large cap names have run their course, or we've got Trump's government talking about protection aspects with respect to chips and with respect to slapping tariffs on and all these things, sort of starts to impede on the frenzy or the optimism around the space. And managers go, where are we going to move to? Because we can't leave stocks. We can't afford to be out of stocks. We can't, we have no mandate to hold cash, which most of them don't. So we have to move sideways here. So they start going into lateral names, which is relative trade. And I always talk about the relative trade because they say, relatively speaking, these small cap names and mid cap names haven't done much for more than 2 years now. And they are relatively cheaper. And that is true, relatively cheaper than the large cap growth stuff, which has gone just off the charts in terms of its times sales, times forward earnings expectations, times book, whatever you want to use. They've gone really off the charts in terms of valuation. So now the capital starts flowing to the small cap and the mid cap, and we've seen that. But what's interesting is that the CRB index, I've been watching commodities really closely. I know you do too, to see do commodities agree that we're off to the races in consumption again here? That the pause in rates and the first cut in Canada and the Fed expected now to perhaps go in July. Will that be enough to suddenly revive consumption in the economy? And what I'm seeing so far is that the commodity index is not voting with that idea. It's saying, still we're not back above the 22 peak when rates were deeply negative, and we're struggling here in a sideways kind of pattern. So that's the first kind of red flag. The other is that the transport sector has not participated in this latest frenzy around small cap stocks. When we look at the price of oil, this is the price of oil back to 2000. Again, it peaked when we were in negative rate territory, right? So back at the peak of 08, in the peak of 11, and then again in 2022 there when everyone was spending their brains out and still consuming based on fiscal stimulus and all kinds of things. But since then, oil's kind of just been sitting, right? Not doing much, not looking really optimistic about the near term or medium term outlook for growth. Copper is an example of something that has really taken off. So you might say, well, copper's supposed to have a PhD in the economic cycle. Surely this is a good sign. And I would say I've seen similar behavior before, and it makes me a little nervous because again, the copper story is really played into the AI story and the electrification story and the EV story, right? There's like this idea of insatiable demand for copper. It's certainly been a very important commodity in all of those sectors. But I think that I'm a little hesitant to conclude that it was bullish on growth. I was starting to be worried that it was more part of this recent frenzy from last October, when you see the rally in the price there really took off with the crypto space again, with the large cap stock space again, with corporate credit was really rising in value and yields were coming off. So again, a lot of that stuff. And now I'm starting to see some reversal there as well. The other thing about copper, we've had, one of the good things about AI and all the innovation that's come, and there's been some really important innovation, especially in the energy space, but there's things like carbon nanotubes now, which are literally something that could work as a substitution or replacement. It doesn't get nearly as hot as copper does in the conductivity space. And some of these new innovations, I think, will eat some of the lunch that has traditionally been taken by or required to have some of the more traditional metal inputs. So I'm watching that very carefully too, just to see. Nickel, again, talk about batteries and all that and electrification. Nickel's typically in that picture, but it too hasn't really participated in this latest round of optimism from the small cap space, et cetera. So this makes me think that lumber, another example, is way back to where it was in 21, not seeing any revival in housing here as far as lumber is concerned, which makes sense to me because, again, tracking the real estate data, yes, housing has come off about 14% in Canada on an average price basis, but we're looking at, leaping inventories of sales at the moment. And I saw a major CEO of a real estate firm this week saying it's a buyer's market and there's no buyers. So yes, mortgage rates have come off a bit from the top. The Bank of Canada cut the overnight rate to 4.75, and we've got, mortgage rates in Canada back around 5%-ish. But given that prices have only come off 14% after having doubled in the 4 years from 16 to sort of 21 or 15 to 21 in that 4 to 6 year period, they're still way above the ability of most households to even begin to buy into these prices. So I think lumber is starting to see that the economy is slowing, that the housing starts data is way off, that we have this issue of how much supply is going to be surplus in this environment and how much supply are we going to, not want to build for a while. So that's another thing that I'm thinking is not really confirming this whole euphoria around the growth story or the value story again. And gold prices, interestingly, we look to gold to be a wise soul in this environment, to be this place of holding value. I've been a little bit concerned again there because it's acting like it did in the 2011 peak, right? When it sort of had this big surge. And again, I'm thinking that at the moment, the actual progress that's happened in gold from 2011 has only happened year to date in 2024. It took all that time just to get back to where it was, right? So you kind of go, gee, you had real negative rates, you had all this incredible consumption, you had all this money printing, you had all this debt addition, and gold only recently just got back to its 2011 high, which makes me think it's, again, it's become this trading vehicle with all the gold ETFs and the funds and the derivative versions and the securities around it, rather than the bullion, the actual metal itself. It's become this financialized asset. And so I would like to see how it behaves when we get into the downward trend, or as some of this excess comes off. I'm watching to see if gold follows suit, just like cryptocurrencies. Bitcoin has had a rally like this in the last while as well, but it's now only back to where it was, but basically at the prior peak as well. So you have to kind of be a little skeptical of that. And then in inflation adjusted terms, of course, gold is really not back to where it was at the 1980 peak, when everyone was wildly crazy about gold and central banks were piling it into their coffers. And, so you see that and you kind of think, okay, the jury is still out there, but I'm worried that it's been too contaminated with this financialization aspect and securitization and trading mentality that has infected really everything.
Yeah.
So I think it might take longer, just as it did in the 2000 downturn, and indeed in the 2007 to 09, although it was a little shorter. It took a while to squeeze all that mania out of people, really to crush them repeatedly enough that they said, uncle, 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 and they finally went to cash. And we haven't seen that yet. So I'm just wanting to see some of that capitulation. Right now, we've got market vein like 70% bullish. I mean, people are really, really in love with risk assets still, even though they've really mostly gone sideways, as I say, for more than a couple of years here. So this is just showing that, again, in the global recession of April to November of 2008, U.S. cash, that's U.S. cash in Canadian dollar terms, actually outperformed gold in Canadian dollar terms and gold in US dollar terms. So a lot of times what people look at as the return on gold, what they're really primarily looking at is the return of the US dollar because it was priced in US dollars. So it's always a question of how much of the appreciation is the price of the gold and how much is a strengthening currency really lending to that picture. And so maybe gold will stand up if we get into a major selling cycle here of these other really frenzied assets, but the jury is still out there, and it didn't do as much as people hoped on that regard in the 2008 cycle. It did revive, but it took some losses first. So again, I think that has to happen sometimes to take all the late bloomers or the late to the party speculative frenzied people out on stretchers, and then you leave room for longer term investment mentality to make some sober assessments. And this is just this option demand for small caps. I know you know about this, but option trading has, again, this is a new crazy, right? So option trading has become 1-day options. Like, this is all marketed heavily to the retail crowd for something to keep them busy and think they're, I don't know if they think they're investing. I think they do think they're gambling. But anyway, whatever it is, it's not investing. And so the last 5 trading days, we saw this big spike in bets on the Russell 2000. And it's interesting to keep in mind, 40% of the Russell 2000 has no earnings at all. 30% of their debt is floating rate, however. So perhaps people are thinking, oh, if the Fed's going to start cutting rates, that'll help these fledgling companies that have mostly the most floating rate debt versus the large cap companies, as I said, who have, they're mostly locked in, or they have very preferential credit treatment. So they're not as helped by cutting rates in this type of environment, whereas the small cap stuff is. I think that's part of what's driving the frenzy right now. But I think it's also just short covering because, again, small cap companies fell for more than 2 years. I think there's been short covering. I think there's been this option frenzy. There's been this value rotation, as they call it, where managers are saying, oh, we're late cycle here. If the large cap stuff's going to start falling, we better move some of that over here to what we call value or small and medium cap. And we saw, again, a similar rotation, just like this happened in the March 2000 to 02 cycle when the Fed started cutting rates. First of all, you see that blue line. So the S&P is the top and the small cap is the red. And you saw that S&P really rallied with small caps into the peak of March because there was this unanimous optimism about all things equities. And then as the Feds finally started in their rate cutting cycle, because they saw some things coming off, the large caps started to roll over. Small caps went with them. And then we got to this period in the fall of 2001 where this value rotation thing starts again, where people go, okay, so we're late cycle, large caps aren't doing it anymore. We need to allocate to these other sectors. And you get to this sort of a spike of inflow. But as you see there, it ultimately proved to be a trade, not an actual bottom in the small cap space. And as capital was required and the cash crunch spread, you saw everything sell off then to the bottom of 2000, the 03 low. And yes, relatively speaking, small caps lost 36%, not 80% like the NASDAQ or 50% like the S&P or the TSX. But it was relative loss was lower. It wasn't that it actually made money or that it was protective of anyone's capital. It's that in that particular cycle, as in this one, small caps were very much cheaper, relatively cheaper than the S&P 500 and the large cap stuff. So relatively, it looked like, all right, well, this is less risk here, but it still went on to lose a significant chunk of money. So I think people should really keep that in mind and realize that their managers are not doing anything to actually protect principal from losses by and large. They're trying to find something that's going to drop less than the overall picture. Because I had this chart as well in the month-end letter as we try and keep our clients very enlightened on this stuff because, typically, and this is the really important takeaway is that as soon as the Fed starts cutting interest rates, they are doing it in response to spiking unemployment and declining GDP growth and inflation finally coming back down. So those things are not positive for the overall economy. Indeed, they're not positive for corporate earnings either, which, by the way, have been uber optimistic looking forward, right, on the growth of what they project to continue straight up in 24 and 25. So once the economy falters, unemployment spikes, consumption's pulling in like it is now, and PS, we've got a housing market downturn, not just in Canada, in other countries and in major cities in the United States as well, then you start to see that earnings start to disappoint. Consumption falters further because people have been let go of their jobs. And that's when the bulk of the stock market finally capitulates and rolls over. It's not before the Fed starts cutting, it's while they're cutting, because that's a contemporaneous impact. They're cutting in response to the negative data. And so that's really a key point here, since they're about to start supposedly in September, if you believe the betting markets right now, either July, but probably September. And the other thing is, when we came into these cutting cycles with the S&P in particular at these really extreme valuations today, like it was in 73, 2000, and 2007, that's when you get these halving events, right? It's not a 25 to 30% market decline, it's a halving that happens. And that really, and it goes on longer than a few months, unlike what happened in 2020, the brief drop and then recovery, and people kind of have that as what a bear market is. No, in these environments, bear markets are much more extended. And then again, just this is always worth remembering. Again, the relative value trade, your typical fund manager, your ETFs, they're all passively allocating to equities at all times. So they look for what might drop less in this environment. They aren't looking for what will probably go up in this environment. They may say that, but the reality is there's a heavy correlation here. And in the average recession, this great little summary just shows you that the so-called defensive sectors, dividend-paying stocks, they're not a safe haven. They fell on average, 40% during the average bear market recession in the last 4 cycles. So just to keep your eyes very open in terms of what you're expecting from them in terms of capital defense. And, as I say, this one's going to be hard on people because they are uber bullish. They're heavily over concentrated in equities. Very few people are holding cash. I think cash is at 4%. Bonds are something like 9%. Equities, they've got the highest allocation they've had since 1950, like worse than the tech wreck top. So that's hard to believe for me, because I never thought we'd get there in my lifetime again, but here we are. And the piece that I just like, because I'm one of the only people that ever talks about bonds, because I know they're boring and people don't get commissions much from putting bonds in client portfolios and all that thing. But the reality is that this just shows you when the Fed is cutting interest rates in the last 9 cycles, Treasury bonds rallied. They were one of the very few things that rallied consistently as safety-seeking flows moved into them, which means yields come down, which is part of this whole re-steepening of the yield curve thing of bringing the rate structure down, is the bond market rallying because the Fed's cutting rates. And so this is just showing you the 2 and the 10-year yield falling, which means the price of those bonds was rising over the 500-day trading day period while they were cutting. And then this chart on the right just shows you that bonds outperform stocks in the 12 months before the cutting cycle and the 12-month period after the cutting cycle. And again, that is because the bond market does more math, and it typically anticipates recessions. It's looking for them. It's concerned about its credit risk, whereas the stock market doesn't do any of that. And especially in a passively driven, inflows, no one's actually looking at the math of anything. So yes, people are talking about, oh, well, they're going to the small cap stuff now because, value is going to outperform growth. Well, small is going to outperform large. It's like, well, if you look at that, value outperformed growth tiny amount in the 1 month after they started cutting. But basically it got its head handed to it in the 3 to 6 month period after there. And gold bars are the outperformance of treasuries. So just like to get that in, because there's very few things to help us in terms of protecting principal in these environments. But cash and money market and compound interest on short-term savings and GICs and bonds are one of the few places that actually does.
Yeah, I appreciate that. It reminds me of something you said right at the beginning. And I noticed this because I host, 3 podcasts per week now on our various channels and have for a few years. And there's usually a divide in the outlook between those who are forming an analysis and providing commentary and those who are managing client accounts. And there's a hard divide there in their outlook. And because one of those groups has to market every month, right? One of those groups has an obligation to a client base and they have to protect principal in reality, not just create theses about what might happen and when and all this stuff, right? Sure. And I want to restate that because everybody who watches my show watches a bunch of shows like this, and pay attention to who's actually got skin in the game and who's managing other people's money, because you are going to get a different take. And I think it's important to recognize that. I'd love to jump back to slide 3 if we could just run right up there. Yeah. So I want to ask a couple questions on the Canadian housing market because there's a lot of curiosity around the health of it, I would say. And 2 things you mentioned here were that mortgage origination thus far in 2024 is at the lowest that we've seen since 2008. And from your client letter, I saw, what is this? Canadian mortgage delinquencies rose 24% year over year in May. My question for you, Danielle,
I need to correct what I said because I just realized so I said that the mortgage applications, Canadian home sales were the lowest quarter since 2008. Mortgage originations were actually, we've never seen anything that low, less than 100,000 nationally. It's not even on the chart. So it's worse than 2008, which makes sense because we really didn't have a bad Canadian housing market in 2008. People lost their jobs, and so they weren't able to qualify for mortgages. But that was a much different type of environment than we have right now.
That makes sense. And actually, yes, in your letter, it says lowest quarter on record for mortgages issued. My question is, what would you speculate? Maybe this is an obvious question, but I just want to hear it from you. The next couple of years in the Canadian housing market to look like. And another data point I'll just add for context here from your client letter, approximately 30% of Canadian mortgages are variable rate, and 70% of those were arranged with fixed payments that therefore do not automatically rise with interest rates over the last 2 years. I'd love you to explain the significance of that, first of all, and then maybe walk through an outlook, if you have one, for the next couple of years in Canadian real estate.
Yeah. So I think the most significant aspect of this, which is unlike any other hiking cycle and cutting cycle that we've ever had in history, is that we got, as I said, to this really unnatural low free money stage where real rates were like negative 5%, but people were getting mortgages at less than 2%. And so in that environment, even if the Bank of Canada cuts all the way down, they typically do a 300 basis points cutting in a normal cycle. Even if they went from 5 to 2 and the yield curve, steepens, and it has been steepening lately, that means low rates have to be lower than higher rates. You're unlikely to see the same stimulative impact as you would have in other cutting cycles, because people got those mortgages so low, number one. And also in the US, a similar phenomenon where I think I saw 60% of mortgages in the US are locked in at less than 4%. Well, the 30-year mortgage is currently at 6.98. So even when the Fed starts cutting the short-term rates, the whole curve will no doubt go down, yields will come down, but will they be enough to give people relief, right? So it's not enough to just get rates back to normal. It's a question of when their mortgage comes up, are they going to get any relief in terms of rates? And the reason that it's so important that we did this crazy interest-only style variable rate mortgages during the worst housing bubble that we've had in decades, The reason that's so damaging is because those banks that allowed people to make fixed payments as rates rose. So in other words, they weren't even covering their interest. Now, what's happened is negative amortization. So the worst of all worse, as their mortgage comes up for renewal, they've even got a bigger balloon of debt than they did when they initially took out the mortgage, when rates were 1.5 or less than 2. And now maybe mortgage rates will be 4, or would they be 3.5? Like, again, if the central banks, if we take them at their word, they don't want to take the front end below 2% this cycle, which remains to be seen, but that is what they're saying so far. And if inflation is stickier, and we can talk about why that might be, but if inflation is not less than 1%, which was kind of unusual, right? Long-term norms is more around 2. So if inflation stays around 2, then, they're not going to have as much room here to work to lower the net cost. And that's why I think it's going to be more of a problem this time for the housing market. Because it's not just as simple as, well, they've lowered rates, now go. It's a function of price too. And it's a function of incomes. It's a function of jobs. And, the thing is, again, the average home price in Canada is now around 700. That's great. It came off from, and I know in the area where I live, north of Toronto, I'm following a lot of listings that are having price reductions. That's very, very typical because, again, there's a lot of listings and very few people able to and willing to buy at these prices. And so you've got this surging inventory. That ought to bring prices down. People tend to be stubborn and it takes a while because they've gotten their head a price. And if they have a mortgage coming up for renewal 6 months from now or a year from now, they may still not be thinking about what those payments are going to look like. They may be thinking, oh, the central bank's already started easing, it won't be a problem. So this is part and parcel what I think, we know traditionally, housing market cycles typically take 4 to 6 years to bottom. So if this one peaked in the spring of 2022, as it did, you could see prices fall for 4 to 6 years from there. This could continue to 26, 28. It really depends how quickly prices fall, because I don't think rates are going to fall fast enough to save a lot of the people that bought during the pandemic or refinanced during the pandemic or took on too much debt, and for the reasons I've already explained. I don't think rates are going to be enough here. We're going to need to have lower prices, and we're going to need to have increases in income, because the average home price today, even at $700,000, is still about 7 times the average household income. Is still way too much relative to historically to 3 or 4 times, which is typically considered max affordability. Right. And of course, in the low rate environment, people didn't even know that rule. I've talked to mortgage people and real estate people who had no idea that was the long-term norm. And they're supposed to be the experts in this field. It gives you some context.
Yeah, not a huge barrier of entry to becoming a realtor, unfortunately.
Well, no offense, because there's good people in that space. I'm not trying to be disrespectful, but I'm just saying it's like stockbrokers at the peak of a cycle, financial people, they throng in when all hell's on fire, and they don't really bring much to the table in terms of understanding, experience, historical perspective. They're mostly given the sales brochure, not the research brochure.
That's it. Yeah. Real estate stocks, if they're on the sales desk, just understand they're on the sales desk. And, okay. And then just to pull on that one topic a little bit more, the negative amortization, just because this might be something that people don't understand. And I think it's very significant. If you have negotiated fixed payments within your mortgage, that means that as interest rates go up, your payment does not. However, your debt obligation does. And so you don't realize that you're owing more money because you're not paying more money. But on the back end, your debt obligation is increasing because as interest rates go up, your fixed payment doesn't. So that additional cash is just bolted onto the back end. And if I understand this correctly, Danielle, the Bank of Canada has allowed mortgages to extend a lot farther into the future than they used to. And again, a point from your letter here, 49% of mortgages in Canada in 2024 have amortization periods over 25 years now. And am I crazy, or did I recall from a previous letter of yours where there are mortgages in Canada now that are extending over 40 years?
Well, sure, because if you look at, like I said, no one's really been paying close attention while rates were rising, and people had these deals of allowing them to keep flat payments. And
Yes.
only about three of the major banks did a lot of these loans, and a couple of them didn't do hardly any of them, thank goodness.
Okay.
But so there is a large chunk of these loans. No one was really paying attention. It was the extend and pretend. It was the, oh,
Yeah.
hopefully by the time this thing comes up for renewal, rates will be lower again. That was the sum total of the thinking around it, I think.
Yeah.
And so the people making the payments are kind of either unaware or just not looking at it, right? They're mostly thinking, okay, hopefully equity will go up enough that we'll be able to, make some money and sell it at a gain and maybe pay down debt. Maybe we'll move or whatever. But the thing is, equity's coming down. Equity's coming down as the debt's going up. So because the prices are now off, as I said, in the GTA where a lot of these transactions took place, prices are off at least 20% in many, many areas, and more if you follow some realtors that are posting some of this listing history stuff. But basically, so the prices aren't going up. The prices are coming down, but your debt is growing. So tell me when you come to renewal. Plus you have bank regulators, PS, who have said to the banks, listen, we want you to get those mortgages in line. So when those things come up for renewal, if their amortization is 30, 40, 50, 60, 70 years at this point, like if that's how long it's going to take them to pay back the mortgage at the current payment, you got to redo that mortgage so that it comes in line. So it's no more than a 25 or 30-year amortization. So once you start doing that with the new total, so even if, as I said, even if interest rates, like current mortgage rates around 5, what if they come down to 4 or 3.5? It's not going to be enough to bail out the people that were in a frenzied buying spree. Again, no one was doing math. Everyone was just afraid to miss out and thinking they were going to get rich quick. Horror show, typical behavior, but horror show. So anyway, so I think that there's going to be a lot of refinancing that won't be possible. Full stop, which means you're going to have motivated buyers. You're going to either have people having to list or giving things back to lenders, and they list because lenders don't want to hold properties.
Yeah.
So I see this inventory issue as going up. Now, people look at the immigration people, the new immigrants, a couple of million people in the last few years in Canada and all that. And yes, a lot of them in the major centers where these property, rents have gone up because of that. There's no question. But it's a question of what kind of supply and what price is it relative to the income of those people. And the answer is it's completely unaffordable. The average immigrant's income is lower than in the first 7 years, is less than the average Canadian's income. And the average Canadian can't afford the average priced home. Never mind the more than $1 million plus that is typical of cities like Vancouver and Toronto. And then you've got all this overbuilding. When money was free and rates were negative, people were building all kinds of crap, right? Like these 400 square foot boxes in the sky, and so-called investors were trading the options, not thinking they'd even have to close flippers and all this stuff. No one was doing any actual investment analysis because they were thinking of who cares, it'll just go up in price. And now it's like, well, who wants to live in those? Well, the people who have any kind of family or dependents or even a couple don't want to rent that thing. They want a 1-bedroom or 2-bedroom, 3-bedroom, and we don't have enough supply of those. And or the price of those, like in Toronto, the average price of a 2 or 3-bedroom is like $5,000 a month. Again, who can afford $60K a year in rent?
Yeah, that's bonkers.
People, So we've got this mismatch both of the supply of type of housing we have and also the current pricing. So I just think that all weighs in favor of prices have to continue to work lower over time. It could happen quickly, like you kind of saw in the 2006-7 collapse in the US, but then prices didn't recover for many years after that. Or you could see prices stagnate here and not go anywhere for a decade, which is another way sometimes these excesses are worked off. I think there's less chance of that. That's what happened in the 1990 to 2000 span in Canada. But we didn't come into things with so obscenely overvalued at that point in 1990, not relative to today, because we'd had a housing bust in 1980. And so prices had come down significantly to 1990, then they fell again, and then they kind of trended sideways for a decade. I don't think that's the environment, given the amount of supply, given the mortgage factors we've been talking about.
Okay.
I think.
So maybe a similar situation happening in the US. I don't know if you have any thoughts on this, but just I'm pulling from Luke Groman's letter last week, hardship withdrawals from 401ks from savers under the age of 49 rocket to nearly 40%. So rising number of Americans are making emergency hardship withdrawals from their 401ks. 40% right now. That's 40% on 1,000 savers. So, and they can make these tax-free withdrawals in certain situations. One of them is to avoid foreclosure or eviction, and that's what the bulk of these are for. Different mortgage situation, but maybe similar market health. What's your take, Danielle? I know there's no federal housing market. It's more local than that,
but certainly Texas, Florida, the ballooning. It's always the same, Jay. It's always where the excesses were the most, where everybody thought you could do no wrong and it was only going up, where everyone was throwing mindless money at everything. That's where it always is going to fall the most afterwards, because all those things people thought to be true are revealed as not. And suddenly there's a rush for the exits and cash liquidation. And that 401k stat, I saw that, and it's pretty shocking. It's typical, again, of something we saw both in the 2000 peak and in the 2008 peak. It's also something that speaks to this reversal of flows out of equities. So again, there's Mike Green and others have done a lot of work on the ETF fund flows and the passive long always fund flows that have come, again, just automatically. A person's working when we had, max employment in Canada and the United States, people are working and they have these employment deductions off their paycheck. And increasingly in the past few years, they've gone 100% into equities, because nobody's, offer, even in those group plans, they don't even offer bond funds typically. They just offer equity products. So everyone's funneled into these equity products. So now, first of all, forced liquidity, because as you say, they're hurting financially and they're trying to keep their roof over their family. Pretty sad stuff, but they're looking to liquidate. So not only that, but they tend to cancel then, where possible, their monthly contributions to those same plans.
Yes.
So this is where you start to see this reversal, and we are starting to see reversal of fund flows. That plus the fact that baby boomers have become net withdrawers. I've talked about this too. Back in 2000, the story was all, well, the boomers are saving, the boomers are in their peak saving years. They're going to keep driving funds into the equity market. So don't worry, it'll never go down. Well, that wasn't true then. It was true that boomers were in their peak earning and saving years. That was true, but it didn't stop the stock market from crashing. Okay. And it's not going to do it now either, especially when the boomers are net withdrawers. And as I showed in that chart, unprepared for any kind of down cycle, because they've got so much of their savings allocated to these overvalued, highly volatile assets, thinking they're somehow defensive but again, it's not the product that makes something an investment. It's the math behind it. It's the use case. It's the value you're paying for what you're getting. That's what makes something an investment, not just because you happen to throw money at something.
So let's, if you could pull up slide 18, actually, I think that's what we're describing right now. The stock exposure, right here. Okay. Yeah.
So this is of financial assets. So this shows around 40% of financial assets in stocks. I've seen, but if you're talking about individual portfolios, it's very common to see people today in their 50s up that have 70, 80% of their money in the stock market, if not 100% of their money in the stock market. Yeah. And this is a financial advice class of folks who think that is sharp and prudent, right? Because they've been through this period of where money was free and people just threw. The other thing that's a big factor right now is, again, I was talking about this at the time a few years ago, private equity became this really big boondoggle of, because rates were low, money was free, So nothing traditional seemed to be attractive. So people were looking for alternate. Alternate was the big buzzword, right? And alternate was these pools of money that said, give us your cash, we'll buy things. And guess what? We won't market to market. So we won't have to show what things are
Yeah.
worth. So
Yeah.
people
Yeah.
will never have to deal with the volatility. They won't have to worry about whether the price is going to go down. They won't react emotionally because we'll never show them that the price is going down. We don't
Yeah.
market to market. But what's happening now, Jay, as you know, is in the last couple of years, funds have been gating withdrawals because people are looking for cash for all the reasons we've talked about, whether it's their, household finances are tight, their business is not doing as great as it was, they're
Yep.
starting to need liquidity. Okay, so now they're looking for what can I get money out of? And those private equity pools are facing so many withdrawals that they're putting down the gates because they're like, oh, we don't have any cash left either. And
Yeah.
you don't want to make us sell stuff right now because, the commercial space, particularly when you do see commercial sales, those things are getting marked down by 60 and 80%. So you want some price discovery. Holy cow. Now they're saying, well, don't make us sell this stuff because then we'll have to admit that the prices are off a lot. And then, you bring down the gates and people want their money out even more. So they defer it and they say, well, you can't take your money out till the fall. This has happened several times now. Oh, in another 3 months, we'll let you take. And then it's like, well, you can take out 5%, but not till Christmas. Well, all this pent up demand just makes people more desperate to start taking money out. So I think that's going to continue for a while here as well. Because the commercial real estate cycle, holy moly, that doesn't clear fast. Those are highly illiquid properties with 25% vacancy rates, property taxes that have gone through the roof. So it's not easy for people to get a business case together for a lot of that property either in terms of buying and investors and sobriety now that people are looking at the math of things.
Yeah. Yeah. Now, everything we touched on, the real estate market, S&P, we looked at commodities lightly. A quote that I think I pulled from your letter at least a couple times this week was, I don't have it in front of me, but effectively, when all the buyers have bought, all that's left are sellers.
That's right. Yeah.
And that's the hangover. That's the post-mania phase that we might be in right now.
That's right. And I still see that in the commentary a lot. A lot of people that post replies or comments, whether they're watching a video or, reading something, they basically, they don't have a clue. They don't have a clue. And I don't blame them because they've been in this crazy time where rates were negative. But they're thinking that, it's all about missing out on what stock you're holding or whether you've got the top 5 and that sort of thing. And they don't realize that that's all earmarks of a mania top, and that those are the ones that typically fall the most when the tides reverse. So yeah, it's been a painful time for someone that's trained as a financial analyst. Like, who needs that kind of credential in this environment, right? You could just throw money and throw darts and be a genius and start a YouTube channel on how you did it. But the thing is that there's just a lot more to it than that. And Jay, you live in Canada. You were in a very popular real estate market during the frenzy in 2022. People thought real estate never went down, right? Yeah. They said all the time, well, it's not like you'd ever lose money in real estate. And I'm thinking, good grief, where did you fall off the potato truck?
That's the very common quote. The best time to buy real estate was 20 years ago. The second best time is today. That's, And
listen, I have real estate and I'm grateful for it, but I wasn't levering it up in 2022 or adding to it or, buying a third and a fourth home. And because I didn't want the overhead. That's the other piece that people don't appreciate is all the additional costs of home ownership, which are not just about mortgage rates, right? Which are about taxes and utilities and maintenance and all that.
It makes sense. If you're probably between the ages of 30 and 50, I imagine. And if your parents were fortunate to own a house, it's probably the home equity that they retired on. I mean, that's the story that so many of us saw. And so you see that. And of course,
however, that story, model. Jay, I agree with you. But that story, what does it also imply? It implies that the person either gets a reverse mortgage, God forbid. The math of that is absolutely cancerous. Or they sell it and buy a cheaper house
Yeah,
and
that's
bank
it.
the money
Yeah.
and then live off of that differential, right? So the tricky bit is how many people actually sold high and can find somewhere cheaper that they want to live and bank the money. And I would submit to you, it's not a lot. It might be a few people, maybe some people had multi-million dollar homes who downsized to $1 million place or something. But I still suggest to you that theme of, oh, well, they're all retiring on their home equity. I always wonder how. Like, how is it working? Show me that. I'd like to see that math.
Yeah. 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 I mean, the downsize from the city to a small town in the Okanagan, common trend in Vancouver for sure. It's get out of the metropolis, get to the small town. Yeah. Yeah.
But they did drive up the prices in the Okanagan and in the Muskokas.
Oh, yeah.
And then the ski country near where I live. The prices there all went above $1 million.
Exactly. Yeah. That exact 100%. Even the town where I'm at, which used to be cheap, I'm in a town of 21,000 people. But it's crazy. It's been bonkers here for a while. So, look, Danielle, I really appreciate your take, and I do find it sobering, but in a really great way, because I feel like whenever I talk to you, we depart so much noise and sensationalism and just get down to like brass tacks. Last question for you. Well, I got a couple more, depending on how your time is, because I could probably keep it for another hour, but I won't do that to you. So just if we could summarize, briefly here, we covered a lot of risk factors in very familiar asset classes, broad strokes, the equities market, real estate. We touched on commodities a little bit. In terms of preserving capital right now, or looking for modest upside, right? We're not looking for FOMO trades, nothing like that. Responsible capital allocation. What's the portfolio look like today for the responsible investor?
So, I mean, it really depends a little bit on your worldview. Some people don't want to ever be out of the equity market. They love having the foot in that door at all times. I would suggest to you that if that's the case, now would be a good time to perhaps flip your typical predilection. Like if you've typically had 80% of your money in the stock market and maybe 20% in cash or some kind of fixed income instrument. Be careful, it's not credit, because credit's correlated with equities. But basically consider maybe flipping that so that you have the bulk of your money now in those cash-like equivalents, and you keep that sort of foot in the door with a much lower risk exposure on the equity side. That's one sort of way to approach it. Other people just don't like to hold things that are falling. So I would suggest to them that there's likely to be better entry points here. Now, there's a couple of things. Obviously, a lot can happen. We've lived through a few years where pandemics happened, where who knows? And if right now it looks like the Trump administration may get in the United States in the fall, and they could bring in these sweeping corporate tax cuts, which they've promised. And, maybe we're going to see companies have a lot more money to buy back their shares at that point, which could be a bullish factor underneath, because they've been the primary buyers of the stock market for a number of years, and maybe they're going to keep doing that. I think that's a risk. That's an upside risk, and that may be one of the reasons a person might say, well, I don't want to not have equities just because of that. But I think the longer term picture here is that the probability is that, because don't forget, even when the Trump administration did that in 2016, you still didn't get the payback. Like the big gig was, well, we'll cut the corporate tax rate, and companies will have, we'll make it back in GDP, right? We'll have so much more growth. They didn't pay for themselves. It didn't work. And it won't work this time, I'm guessing. I think it's highly unlikely, especially the country's that much more indebted, that much older in population. The business cycle is already in a pretty gaining momentum to the downside here. And then we've got this whole problem with how to stimulate through rate cuts when people took out money at these really, century lows, and how to stimulate now, even if you cut back a bit. So I think that the preponderance of that is likely to be disappointing economic growth and job loss for the next year or so. And, that means that that some of this, the stock stuff that we've been wanting to add, the dividend paying stuff that we've been patiently waiting to add to portfolios, is likely to come down significantly, which will be awesome. Because again, the compound rates that you've seen where you have something at 5% and you're rolling that cash back in and saving, that's how you get money growth. Well, dividends, if you can get dividends 7, 8, 9%, which has been typical when you buy them low at these other cyclical bottoms, like in 2002, 3 and 2008, 9, you got this dividend flow, and the price risk had come down so much that it became a much more attractive investment opportunity. So I think that's a very probable base case in the next year or two as these factors play out. So as much as I can't be certain about any of this. There's no certainty. I get a joke out of when people say, oh, markets hate uncertainty. I've never known anything that's certain, but there's probabilities that and behaviors that you can monitor. And again, at some point here, people are they're souring on the real estate market now. They're going to sour on the equity market too. And cash is going to become in demand. So those that have that cash in advance are going to be the strong hands able to buy from people liquidating. That'll be true in real estate as well. But it just might take another, typically it's a longer cycle because it's not as liquid as equities and securities and things like that. So it could take another, but you should always do, and if you don't know how to do the math, then you shouldn't be buying this stuff, quite honestly, or you should find someone who can help you that does know how to do. But I'm saying, on certain properties in real estate, no doubt, there will become a price offering where you do the math on rents and it's like, wow, there's a huge buffer there. This is cash flow positive. This is awesome. And it might be an attractive thing to do if you have the money and or have some money and can borrow cheap, etc. But it's always a function of that cash flow analysis.
Yes. Okay. Look, Danielle, I want to thank you for coming on today. Venablepark.com for the investment counsel services, jugglingdynamite.com for your nearly daily blog, which is very impressive, by the way. And that's a free blog. Anybody can go to jugglingdynamite.com and check out what Danielle's thinking about today on the markets and in life. Thank you so much for your time. It's always a pleasure catching up with you. I really appreciate it.
Yeah. Thank you, Jay. You too.
All right.